It's really not surprising that any decline is met with new buying fairly quickly. I mean, we have ebbs and flows. We had China was out of the market for like 4 or 5 months. Now in July, they just bought for, I think, the 8th month running. So you have other countries that come and go, but overall, it strikes me that there's still a lot of buying to come from the central banks. So I think there's a lot of potential for central banks to continue to increase their holdings of gold, and that's what's going to really drive the gold. That's what has been driving the gold market.
The most significant force in the gold market right now isn't hedge funds or ETFs. It's the world's central banks, and their buying spree is quietly rewriting the rules for how gold is valued. Adrian Day, founder and president of Adrian Day Asset Management, says central banks have been the largest buyers for 3 consecutive years, steadily reducing their reliance on the US dollar due to concerns about its weaponization. Gold has now surpassed the euro as the second largest reserve asset, accounting for approximately 22% of global reserves. That's still well below historic norms, with many countries holding just 2 to 5% in gold, leaving huge room for further accumulation. Currently, central banks collectively hold more than 36,000 tons of gold. In the second quarter of 2025 alone, their purchases were 41% above historical averages, according to the World Gold Council. But they're not the only ones driving demand. The second largest buyers this year have been Chinese private investors, who are hedging against currency devaluation and the lack of safe alternatives such as cryptocurrency or real estate. In July, China's gold reserves rose by roughly $1 billion to a total of $244 billion. Since resuming purchases last November, the People's Bank of China has added 1.16 million ounces to its stockpile. The third wave of demand originates from wealthy individuals and institutions across the Middle East, Asia, and Europe, as well as a few in North America, who are concerned about surging global debt and unsustainable fiscal policies. In Asia and the Middle East, gold ownership is deeply rooted in history, culture, and hard-earned lessons about currency collapses and high inflation. Some of Asia's wealthiest families are taking it to another level, running gold operations like old-world trading houses, not just passive investments. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, I certainly don't think we've topped out. I mean, definitely we've got a long consolidation here, or a multi-month consolidation. To me, what is most impressive and most impressive about gold is that we haven't had a meaningful decline. I mean, you've got that decline there in May, and then we came right back from it. Mm-hmm. But we haven't had a meaningful decline in terms of both value and time. We really haven't had one this whole bull market. And that to me that just demonstrates gold resilience. Now, in a way we can understand now when we look at who are the drivers of the gold market, who's been buying and why they've been buying. And if you're looking at obviously the central banks of the world have been the largest buyers of gold for the last 3 years, and they've been buying to diversify their assets away from the dollar in the face of dollar weaponization. And I think it's important for people to understand the central banks were already diversifying away from the dollar for years, but of course, what happened with the Russian assets just stepped that up, accelerated that move. But this is a long-term move. It's not something that just happened recently, and it certainly just didn't happen this year since President Trump came in. It's a longer-term move. It seems to me that when you look at the buying of the central banks over particularly, let's say, the last 3 years since the Russian asset seizure, there's really no reason to think that that's going to slow down anytime soon. And so in that sort of light, it's really not surprising that any decline is met with new buying fairly quickly. I mean, we have ebbs and flows. We had China was out of the market for like 4 or 5 months. Now in July, they just bought for, I think, the 8th month running. So you have other countries that come and go, but overall, it strikes me that there's there's still a lot of buying to come from the central banks. You look back to the beginning of the century, 1999, and the dollar represented about 75 to 80, somewhere in that range, 75 to 80% of all global central bank foreign reserves. And that was down to about 65% 5 years ago. Again, I emphasized before the Russian asset seizure, and now it's accelerated down to around 47%. And this is even as dollar reserves are growing, or the amount of dollars around are growing. The amount of dollar, as we know, the trade deficit, with the US trade deficit is very high, which means that foreign countries are earning more dollars. So they're continuing to earn dollars, but they're now getting rid of them, if you like, sooner than they otherwise would have done. And the percentage is now down to around 47.5%. Gold has moved up, replacing the euro as the number $2 foreign reserve asset of central banks. It's about 22%. 22% is moderately high, but of course it's a lot lower than it was 60 and 70 years ago. And of course, there's some countries that have high gold reserves. There's still a lot of countries that are at 2, 3, 4, 5%. So I think there's a lot of potential for central banks to continue to increase their holdings of gold. And that's what's going to really drive the gold. That's what has been driving the gold market. Now, if you look at the North American investor, particularly the US investor, they've been kind of lukewarm on physical gold and actually negative on gold stocks. Maybe we'll talk about that later, but with regard to gold. And again, there's a logical reason for that, because the sort of economic factors that typically drive US investors towards gold, namely a weak economy, low and declining interest rates, high and increasing inflation, and a weak dollar, they really hasn't been the environment that we've been in for the last several years. Obviously, the dollar has been weak this year, but it's only been relatively weak. I mean, if you look at the dollar on a 5-year basis, it's not so. Nobody would say it's super weak. I've got several coin dealer friends. I talked to one 2 weeks ago. He said he's never been busier in his life. Unfortunately, 3/4 of the people calling him are selling, not buying. And you're seeing that with mutual funds. I mean, we manage Peter Schiff's gold mutual fund. I can't tell you specifically what's happening, but I can say that the gold mutual funds in general, and we're no exception, are getting many more outflows than inflows, even with these all-time highs. And again, you look at the public information like GDX and GDXJ. GDX has lost, that's both seniors. GDX is the largest ETF for senior miners. We've seen some inflows in the last week, but it's still lost $114 million in the last month. It's lost $6.5 billion of assets this year. $6.5 billion of assets. For a fund that's only $17 billion, and that's today, after we've had the gold stocks go up 70%, to lose $6.5 billion, that's meaningful. You look at a GDXJ, which is they call it the juniors, not really juniors. Intermediates would be more like it, but that's less than 6 billion market cap. And we've lost 1.2 billion this year. So, I mean, the money is just flowing out of the gold sector in North America. I think that's going to turn. I think it's beginning to turn. I said that the GDX has seen some inflows in the last week. I think it's beginning to turn, but it will turn dramatically, in my view, when it's clear that the economic environment is changing. When the Fed cuts rates are going down, and it's clear that the direction is downwards. When inflation starts to pick up, and you will get to eventually the point where you have negative real interest rates, which will be in other words, interest rates below the rate of inflation. Very positive for gold. As the economy slows, if the dollar continues to weaken, then the environment becomes very, very attractive, or conducive, shall we say, for gold investments.
Central banks, private investors in China, and the world's wealthiest families have all been steadily stacking gold. But here's the thing. According to Adrian Day, the real breakout for gold might not have even started yet. Day says the real turning point will come when the Federal Reserve's shift to rate cuts is unmistakable. If that happens at the same time inflation pushes higher and real interest rates turn negative, you've got a textbook setup for a gold rally. Add a weaker dollar and a slowing economy to the mix, and the stage is set for a significant move. We're already seeing hints of it. July's inflation numbers showed the fastest underlying price growth since the start of the year, according to the Bureau of Labor Statistics. Goods inflation remained calm, but traders in the swaps market are still betting that the Fed will cut rates in September, especially with labor market data softening. Gold's appeal jumps in a lower rate environment because it doesn't pay interest, so the opportunity cost of holding it falls. That's part of why it popped as much as 0.5% earlier, helped by a dip in the dollar. That drop followed a Fox Business report that President Donald Trump's pick to run the Bureau of Labor Statistics had suggested suspending the monthly jobs report before his nomination, a headline that jolted currency markets. Day also points out a key relationship with silver. If silver rises, gold almost always rises too, but the reverse isn't guaranteed. There's no realistic world where silver skyrockets while gold slumps, especially during a potential monetary reset or a period of aggressive central bank reserve building, where gold remains the anchor asset. Let's get back to the interview.
I think there's been four main buyers. The central banks have been number one, no question. Chinese non-official buyers have been the second largest. At the beginning of this year, they weren't in last year, but at the beginning of this year, you saw a huge spike up in Chinese non-official buying. And that's been relatively strong most of the year until just maybe the last month, 6 weeks. But that's based on a fear of yuan devaluation. They don't trust the banks. The banks over there are very fragile. They're not allowed to invest in crypto. And so gold becomes the obvious place to put your money if you want to protect your savings. Because if you're Chinese, you're not going to buy Chinese real estate right now to protect your savings. So that's been the second largest. And I think the third largest buyer, we are clearly seeing wealthy individuals, families, institutions in the Middle East and in Asia, also in Europe, to a much lesser extent in North America, but we're seeing it in North America, people who are quietly buying gold because they're just concerned about the debt levels in the world and the fiscal situation of the US, but also of many other countries around the world. The US is by no means the most extreme in terms of fiscal situation. Having the world reserve currency, of course, makes it a very important deficit, but there's other countries, Japan, many other countries with much higher fiscal deficits than the US. And people are really getting concerned about that because how do you solve that situation? It's one thing if one major country has a lot of debt, but if everyone is running huge debts, how are we going to solve that situation? We can't solve those deficits by increased taxation. The numbers just don't work. And that's ignoring the fact that when you increase taxing, you slow the economy typically, the Laffer curve and all of that good stuff. But the numbers just don't work. And so how are you going to solve that situation? And I think people are becoming increasingly concerned about some kind of monetary reset. And gold is the obvious thing to protect yourself against that. Gold, to me, has the best risk reward. There are scenarios, very, very rational, possible scenarios I can envision where gold will do well, but the other metals will not. Whereas any scenario I can think of where silver will do well, gold will also do well. May not do as well, but it will do well. You're not going to have a scenario where silver goes up and gold goes down. So gold to me has the best risk reward, particularly if we're looking at some kind of monetary reset. We're looking at central banks increasing their reserves. Gold, you asked about silver and Russia, but gold is still always going to be the dominant of the metals in reserves. So gold will be my number one. Silver, of course, as we all know, it has the potential to have these bigger spikes than does gold, and it's by no means expensive. So I would definitely have some gold. I'm not as convinced on platinum as a lot of my friends, people I respect, but I'm just not as convinced on that. And to me, that's a different kind of investment. It's certainly not a long-term, insurance security hedge. It would be much more of a shorter-term speculation. Again, nothing wrong with that. I don't want to make it sound like speculation is a bad word, but so if I were looking, for how to allocate for the relatively long period of time, I would probably put 75% in gold and 25% in silver. I'm not sure how much the market is talking about a possible QE, because when you listen to the Fed, all of their last meetings, it hasn't been a big focus, but at every meeting they've said, we're continuing to run off the balance sheet and, QT's continuing. And it's just astonishing to me that no one in that room, none of the media ever asks them a question about it. So you never get any expansion, but I'm not sure how much that is really being talked about, to be honest, because people are obviously talking about the debt funding, and we know a lot about that. We know that China and Russia, not Russia, Russia's out. We know that China and Japan, the two largest foreign holders, we know that they're selling for different reasons, but they're selling. We know that the Social Security Fund, which is one of the largest holders of treasuries, they are not in a position to buy more. They are beginning to slowly sell down. We know that the regional banks in the US, which again have been traditionally, or for the last couple of decades, have been a big buyer of treasuries. We know they're not doing it because of all that, all of the problems that arose with that mark to market and hold to maturity 2 years ago. Remember, they got Signature Bank and Silicon Valley Bank into trouble. They are not, and the regulators have been looking at those holdings, so they're not a big buyer. So we know all of that. That's all in the market. We know that the issuance of treasuries for the rest of the year is going to be meaningfully higher than it has been for the first 6 months because of the debt ceiling. So up until the debt ceiling was raised, there was virtually no new issuance of treasuries. The only treasuries that were issued were older treasuries rolling over, but the actual number didn't increase. Now, as I said, we're looking for probably an additional 1.6 trillion over a period of 4 months. So pretty meaningful. We know there's a couple of things, Besant is doing all the accounting tricks that are normal, but he's also trying to get some new buyers in. So we have the issue where the big banks won't have to hold so many treasuries won't have to hold so much in reserves anymore. And the Treasury is hoping that some of that money will be used to buy treasuries. How much is uncertain. Jamie Dimon, the CEO of Morgan Chase, the biggest bank, has said they're not interested in increasing their holdings of treasuries, which is a pretty astonishing statement to make. He, of course, is one of the more outspoken of the bank CEOs, but nonetheless, I don't know how much they're going to raise there. The Genius Act, allowing, lighter regulation of fully backed stable coins. That's another, whatever you want to call it, another avenue. I was going to say gimmick, another avenue for getting new buyers into the treasury market. How much of that's going to come this year is uncertain because it may be a meaningful thing next year and the year after and the year after, but you've got to set up the fund, you've got to get it through the SEC. These things take time, right? So I don't know how much demand is going to come from that.
Gold's current momentum is being fueled by a convergence of structural forces rather than short-term speculation. Central banks are quietly reshaping the market by making gold a core reserve asset again. At the same time, private buyers in Asia and the Middle East continue to build holdings as a safeguard against currency instability and debt risk. With inflation ticking higher, the Fed leaning toward rate cuts, and the dollar showing signs of weakness, the setup for a major breakout is forming. If these trends align, the next leg up in gold could be both swift and significant, pulling silver along for the ride and potentially marking a turning point in global wealth allocation. How might this shift in central bank and private accumulation change the long-term balance of power in the gold market? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.